Hey everyone, welcome back to Corporate Decoder, the place where we dissect the money secrets of big corporations. And today we are diving into the Franklin Short Duration US Government ETFs Annual report from October 2025 to September 2025. This filing is a treasure trove of information for anyone interested in how this fund operates and where your money might be going, so buckle up. Before we dive into the juicy details, if you love getting straightforward insights into complex financial documents, a place where we translate the jargon into plain English, make sure you hit that subscribe button. We also have a fantastic community over on Discord, linked in the description below, where we discuss these filings and much more. Let's get started. So what is this fund all about? Well, it's a specific investment series from the Franklin ETF Trust, and it aims to give you a good income stream while keeping your initial investments safe. It's an actively managed exchange-traded fund, or ETF, meaning it trades on a stock exchange, like regular stocks, but it's backed by a basket of investments. Now for the numbers, let us look at the cost side of things for a hypothetical investment of $10,000 over the last 6 months. The Franklin Short Duration US Government ETF cost investors just $12, that is 0.24%. That is incredibly low, folks. This suggests the fund is very efficient at managing its expenses. Moving on to the size of the operation, as of the 30th of September 2025, the fund had total net assets of $245,999,446. That is over $245 million. This is a substantial amount of money managed by this fund, showing it is a significant player in its market. Let's talk about how often the fund buys and sells its investments. The portfolio turnover rate was 32%. This means that about a third of the fund's holdings were changed over the reporting period. This is a moderate turnover rate, indicating a strategy that involves some active trading but not excessive speculation. Now let's break down what the fund actually invests in. A significant portion, a whopping 40.5%, is in mortgage-backed securities. These are essentially bundles of mortgages that are sold to investors. When we look deeper into this category, we see holdings like FHLMC, which is Federal Home Loan Mortgage Corporation securities, and FNMA, which is Federal National Mortgage Association securities. These are government-sponsored enterprises that play a big role in the housing market. For instance, under the mortgage-backed securities category, the fund holds a significant amount of Federal Home Loan Mortgage Corp securities with various rates and maturity dates. For example, they have a 5.50% rate security maturing in December 2054 to September 2055, with a face amount of over $17 million and a value that slightly exceeds that. This indicates substantial exposure to mortgage debt. Similarly, they have large holdings in Federal National Mortgage Association securities. For example, they hold over $20 million worth of 6.000% rate securities maturing in July 2053 to August 2055. This again shows a heavy concentration in mortgage-related assets. Besides mortgage securities, the fund also holds us government obligations, comprising 28.5% of its investments. This is where the safety aspect comes in. These are investments in US Treasury notes with various interest rates and maturity dates ranging from November 2025 all the way to February 2027. This provides a more stable part to the portfolio. Adding to the mortgage exposure are collateralized mortgage obligations, which make up 26.5% of the fund. These are also derived from mortgage pools, but are structured differently, often with specific classes of obligations having different payment priorities. This is a complex area of investment, but it forms a substantial part of the fund's holding. One important note in the financial statements about how these investments are valued is the reliance on independent third-party pricing services. These services use observable inputs like interest rates, yield curves, and credit risks to determine the value of fixed income securities. When these services can't provide prices, or their prices are considered unreliable, the fund manager steps in to determine the fair value. This is a crucial aspect of fund management, ensuring accurate reporting. Looking at the expenses, the investment management fee for the 6 months ended the 30th of September 2025 was $289,157. However, the fund received fee waivers and expense reimbursements totaling $10,475. This means the net expenses were $278,682. This GNS with the low cost we saw earlier, the fee waiver is a positive sign for investors as it further reduces the burden. The result of this income and expense structure is a net investment income of $5,000,000 $215,486 for the 6 months. This is the profit generated from the fund's investments after all expenses are paid. Beyond just income, the fund also experienced gains and losses on its investments and futures contracts for the 6-month period. There was a net realized gain of $222,944 and a change in net unrealized appreciation of $519,980. This means the value of the investments went up overall during this period. The total increase in net assets from operations was a healthy $5,958,410, showing good performance. When we look at the financial highlights and specifically the total return based on net asset value, or NAV, we see some interesting figures for the period ending the 31st of March 2025. The total return was 5.73%. That is a solid return considering this is a short duration government fund and net asset value. Per share ended at $90.85 on the 30th of September 2025, which is a slight increase from the prior period. And those net expenses we talked about were a mere 0.24% on an annualized basis. This is extremely competitive in the fund world. This low expense ratio directly benefits investors by leaving more of the returns in their pockets. The fund also engages in futures contracts to manage risk or gain exposure. For example, they had contracts to buy us Treasury 2. Year notes with a notional amount of nearly $49 million, but also contracts to sell us Treasury 5, year notes, and long. Term bonds, the net result of these futures contracts was a net unrealized depreciation of $167,110, indicating a slight loss on these hedging or speculative positions, but it helps manage overall portfolio risk. Looking at the changes in net assets, we see a steady inflow of capital for the 6 months ending the 30th of September 2025. The fund saw an increase in net assets of over $25 million, primarily from the sale of shares. The cost of shares repurchased was significantly less than the proceeds from new shares sold, indicating net new money coming into the fund. This growth is a positive sign. And now for the big picture, what does all this mean? The management of this fund appears to be quite hands-on. They are reviewing performance, considering market trends, and even exploring technological innovations like tokenization and blockchain. This suggests a forward-thinking approach to fund management. The quality of services provided by the manager was deemed satisfactory, keeping costs low and performance in line. In terms of performance, the fund is doing well for its category. Its annualized total return for several periods was above the median of its peer group. This means that investors are getting competitive returns for the type of investment. This is the core of what any investor wants to see their money working for them effectively. And concerning fees, the fund is priced competitively. The management rate is at the median for similar exchange-traded funds, meaning it's not overly expensive for the services, provided the fact that they have implemented a unified management fee, where the manager covers most operating expenses, is a big plus for investors. This structure aligns the manager's interests with keeping expenses down. So to sum it all up, the Franklin Short Duration US Government ETF in its September 2025 report shows a fund that is managing its investments prudently with a heavy emphasis on mortgage-backed securities and US Treasuries. Its expense ratio is remarkably low and its performance is competitive within its peer group. The inflows of cash suggest investor confidence, and the management team appears to be actively engaged in providing quality services and exploring new technologies. This fund seems to be a well-oiled machine, delivering steady results with a clear strategy. Now, this analysis is based on the numbers and what they tell us about the company's direction and financial health. What are your thoughts on this report? Do you think the fund is well positioned for the future, or are there any red flags you noticed? Let me know your take in the comments below, and if you found this breakdown helpful, please give this video a thumbs up. It really helps our channel grow, and be sure to subscribe for more in-depth corporate financial analysis like this. Don't forget to join our Discord community, linked in the description, for more real-time discussions and insights. Thanks for watching, and we'll see you in the next video.